Look, I'm not going to sugarcoat this. What's happening right now in the gold market isn't just another cycle. It's not just another bull run. This is something fundamentally different. And if you're not paying attention, you're going to wake up one day wondering why your purchasing power evaporated while everyone else seemed to know something you didn't. Gold just crossed $3,900 per ounce. Let that sink in for a moment. We're not talking about a modest gain. We're talking about a metal that's been climbing relentlessly while most people are still debating whether inflation is transitory or wondering if their 401k will recover. But here's what nobody's telling you. This isn't about the price of gold going up. It's about the value of your dollars going down, and the smartest money in the world has already figured this out. Central banks are buying gold at a pace we haven't seen in over half a century. We're talking about institutions that literally print money, that control interest rates, that have access to every economic indicator before you do. And they're dumping dollars and buying physical gold like their survival depends on it, because it does. The People's Bank of China added another 225 tons in recent quarters. Russia's been accumulating for years. India, Turkey, Poland, Singapore, countries that rarely agree on anything, are all doing the exact same thing. They're converting their dollar reserves into gold, and they're doing it quietly, methodically, and without fanfare. Why? Because they know something that most Americans are too distracted to notice. The dollar's dominance is ending, not tomorrow, not in some dramatic collapse that makes headlines, but in a slow, grinding erosion that's already well underway. The BRICS nations, Brazil, Russia, India, China, South Africa, are building alternative payment systems. They're settling trade in their own currencies. They're creating mechanisms to bypass the dollar entirely. And every time they do, the demand for dollars drops just a little bit more. You know what happens when demand drops and supply keeps increasing? The value falls. It's basic economics, and the US has been printing dollars like they're going out of style, which, ironically, they are. Let me paint you a picture. It's 1971. President Nixon closes the gold window. For the first time in history, the dollar isn't backed by anything except the government's promise. People were worried then, but the dollar was strong. America was the undisputed economic superpower, and everyone needed dollars to buy oil. Fast forward to today. The petrodollar system is crumbling. Saudi Arabia is accepting yuan for oil. The economic superpower status is being challenged. And that promise? It's backed by $36 trillion in debt and climbing. Here's where it gets interesting. The gold market isn't like the stock market. It's not driven by earnings reports or quarterly guidance. It's driven by fear, by uncertainty, and by the cold, hard realization that paper currencies have a 100% failure rate throughout history. Every single fiat currency that's ever existed has eventually gone to zero. The dollar's been around for about 250 years. The average lifespan of a fiat currency? About 27 years. We're living on borrowed time. But let's talk about what's happening right now, today, in the physical gold market. There's a disconnect that's absolutely fascinating if you understand what it means. The paper gold market, the futures, the ETFs, the derivatives, that's where most people think the price is set. But the real action is in the physical market, and physical gold is getting harder to find. Dealers are reporting delays. Premiums over spot price are widening. The U.S. Mint has had to ration gold eagles multiple times. These aren't signs of a healthy liquid market. These are signs of stress, of tightness, of a market where demand is overwhelming supply, and the people who need to deliver physical gold are starting to sweat. You want to know why? Because for every ounce of physical gold that exists, there are probably 100 paper claims on it, maybe more. It's the same game the banks played with mortgages before 2008. Slice it, dice it, sell the same thing multiple times, and hope nobody asks for delivery all at once. Except this time, people are asking. Central banks are asking. Wealthy families are asking, and the system is starting to crack. I was talking to a dealer recently who told me something that should terrify anyone holding significant cash. He said his clients used to buy gold as a small hedge, maybe 5 to 10% of their portfolio. Now, they're coming in wanting to convert 30, 40, sometimes 50% of their liquid assets into physical metal. These aren't conspiracy theorists. These are doctors, lawyers, business owners, people who've built wealth and are now desperately trying to protect it. And here's the thing. They're not wrong. Look at what gold has done compared to the stock market over the last few years. Sure, stocks have had their moments, but gold has been quietly, consistently grinding higher. No earnings disappointments, no CEO scandals, no bankruptcy risk, just steady, relentless appreciation in the face of currency debasement. Now I know what some of you are thinking. But gold doesn't pay dividends. It doesn't generate cash flow. It just sits there. And you're absolutely right. Gold doesn't do anything. That's the point. It doesn't need a functioning economy. It doesn't need consumer confidence. It doesn't need the Federal Reserve to keep interest rates at a certain level. It just is. And in a world where everything else is dependent on 1,000 different variables all going right, that simplicity is incredibly valuable. Let me tell you about something that happened in 2008. When Lehman Brothers collapsed, when the entire financial system was on the brink, you know what happened to gold? It dropped initially, because everyone was selling everything to raise cash. But then something interesting occurred. While stocks took years to recover, gold bounced back in months and then kept climbing. It went from around $800 an ounce to over $1,900 by 2011. Why? Because people realized that the system they'd trusted was built on sand. We're in a similar moment right now, except the stakes are higher. The debt is bigger, the money printing is more extreme, and the alternatives to the dollar are more developed. China isn't some backwater economy anymore. It's a technological powerhouse with the world's largest manufacturing base. When China and Russia and India start trading in their own currencies, backed by gold, that's not a theoretical threat to the dollar. That's an existential one. And here's what keeps me up at night. Most Americans have no idea this is happening. They're watching their favorite shows, scrolling through social media, maybe checking their 401k once a quarter and feeling okay because the number went up a little. They don't realize that the number going up doesn't mean anything if the currency it's denominated in is losing value faster. Think about it this way. If your portfolio goes up 10%, but inflation is actually 15%, you didn't make money. You lost purchasing power. And the official inflation numbers? They're a joke. They don't include food and energy, the things you actually need to live. They use hedonic adjustments and substitution effects to make the numbers look better than reality. The real inflation rate, calculated the way it was in 1980, is probably double or triple what they're telling you. So what do you do? How do you protect yourself when the currency itself is the problem? Quick aside here. If you're sitting on $100,000 or more in retirement accounts, I put together a free guide on how gold IRAs work. It's in the description below. It covers how to get physical gold into your retirement account without triggering tax penalties, how the process actually works, and what to watch out for. If that's relevant to your situation, it's worth a look. No pressure, just information. Anyway, back to the bigger picture. The gold market is telling us something right now, and we need to listen. When gold breaks through major resistance levels, $2,000, then $2,500, then $3,000, now pushing past $3,900, that's not random. That's not speculation. That's capital fleeing from something and into something else. It's fleeing from uncertainty and into certainty, from promises into reality. And the thing about gold is that it's nobody's liability. When you hold a dollar, you're holding a promise from the U.S. government. When you hold a bond, you're holding a promise from a corporation or government. When you hold a stock, you're holding a claim on future earnings that may or may not materialize. But when you hold gold, you're holding an asset that's been valued for 5,000 years, that's survived every empire, every currency collapse, every financial crisis. It doesn't promise anything. It just is. Let me tell you about what happened in Weimar Germany. Most people know the story. Hyperinflation, wheelbarrows full of cash to buy bread, currency becoming worthless. But here's what they don't tell you. The people who survived that with their wealth intact were the ones who got out of paper currency early. They bought real assets, land, businesses, and yes, gold. While their neighbors saw their life savings evaporate, these people preserved their purchasing power and came out the other side. Okay, we're not in Weimar Germany. I'm not predicting hyperinflation tomorrow, but I am saying that the warning signs are there and they're getting louder. When the world's central banks are buying gold at record levels, when physical premiums are widening, when the BRICS nations are building alternative systems, when debt levels are at all-time highs and still climbing, these aren't isolated events. They're all pointing in the same direction. The gold-to-silver ratio is another fascinating indicator. Historically, it's been around 15:1 or 21. Right now, it's been as high as 81 or 91. That means gold is extremely expensive relative to silver, or silver is extremely cheap relative to gold. Either way, there's a distortion in the market. And distortions don't last forever. They correct, sometimes violently. But let's focus on gold for now, because that's where the real story is. The supply side of gold is fascinating. Gold mining production has been essentially flat for years. It's getting harder and more expensive to find new deposits. The easy gold has been mined. What's left requires going deeper, into more remote locations, with more complex geology. That means higher costs and longer development times. Meanwhile, demand is surging, not just from central banks, but from individual investors who are waking up to what's happening, from Asian buyers who have a cultural affinity for gold that Americans have largely lost, from institutions that are starting to view gold not as a barbarous relic but as a strategic asset in a world of currency instability. Supply flat or declining, demand increasing. You don't need an economics degree to know where that leads. And here's something most people don't understand about the gold market. It's tiny compared to other markets. The entire above-ground gold supply is worth maybe $15 trillion. That sounds like a lot until you compare it to global stock markets at over $100 trillion, or bond markets at over $130 trillion, or real estate at over $300 trillion. If even a small percentage of money from those markets flows into gold, the price impact would be enormous. We're already seeing this happen. Gold ETFs have seen massive inflows. Sovereign wealth funds are increasing their allocations. Family offices, the investment vehicles of the ultra-wealthy, are buying physical gold and storing it in private vaults. These aren't dumb people. They have access to the best research, the best advisors, the best information, and they're buying gold. Let me tell you about a conversation I had with someone who works in private banking. He told me that their high net worth clients, we're talking people with $50 million, $100 million, $500 million, are increasingly asking about gold. Not as a small hedge, but as a core holding. They're worried about currency debasement. They're worried about political instability. They're worried about a financial system that seems to lurch from crisis to crisis, held together by ever-increasing amounts of debt and money printing. And these people have options. They can buy anything. They can invest anywhere. They can move their money to any country, any currency, any asset class. And they're choosing gold. That should tell you something. Now, I'm not saying you should put everything into gold. That would be foolish. Diversification matters. But I am saying that if you have zero exposure to gold, if you're 100% in paper assets denominated in dollars, you're taking a massive risk that you might not even realize you're taking. Because here's the thing. The dollar's value isn't determined by some natural law. It's determined by confidence, by the belief that the U.S. government will honor its obligations, that the Federal Reserve will maintain stability, that the system will continue to function, and that confidence is eroding. You can see it in the bond market. Treasury yields have been volatile, with foreign buyers stepping back. You can see it in the currency markets, with the dollar index showing weakness despite the Fed's efforts. You can see it in the gold market, with prices hitting record highs despite no major crisis. Yet. That yet is important. Because gold doesn't wait for the crisis to arrive. It anticipates it. It's a leading indicator, not a lagging one. By the time the crisis is obvious to everyone, gold will already be at prices that seem insane from today's perspective. Think back to 2008. If you'd bought gold in 2007 before the crisis hit, you would have felt pretty smart by 2011. But most people didn't. They waited until the crisis was obvious, and by then, gold had already doubled. The same thing happened in the 1970s. The smart money bought gold in the early 70s, after Nixon closed the gold window. The late arrivals bought at $800 in 1980, right at the peak, and then suffered through a 20-year bear market. Timing matters. And right now, we're in the early stages of what could be a historic move in gold. We're not at the panic stage yet. We're not at the stage where your neighbor is talking about buying gold, where mainstream financial advisors are recommending 20% allocations, where gold is on the cover of every magazine. That comes later. Right now, we're at the stage where the smart money is accumulating quietly before the crowd figures it out, and the crowd always figures it out eventually. They just figure it out late. Here's another thing to consider: the geopolitical situation. We're living in a world that's becoming increasingly multipolar. The U.S. isn't the undisputed hegemon anymore. China is rising. Russia is assertive. Regional powers are flexing their muscles. And in a multipolar world, there's no single currency that everyone trusts. So what do you use as a neutral reserve asset? Gold. That's why central banks are buying. They're preparing for a world where the dollar isn't the automatic choice for international trade and reserves. They're diversifying. They're hedging. They're doing exactly what any rational actor would do when faced with uncertainty about the future of the global monetary system. And if central banks, with all their resources, all their information, all their expertise, are doing this, what does that tell you about what individuals should be doing? The answer is obvious. You should be doing the same thing, scaled to your situation. You should be taking some of your paper wealth and converting it into real assets. And gold is the most liquid, most recognized, most historically proven real asset there is. Now, I know some people will say, but what if I'm wrong? What if the dollar stays strong? What if gold goes down? And those are fair questions. But here's my response. What if you're wrong about the dollar? What if the current system is more fragile than you think? What if the next crisis is worse than the last one? What if the money printing continues until confidence breaks? The risk of being wrong about gold is that you hold an asset that doesn't generate income but maintains its purchasing power. The risk of being wrong about the dollar is that you lose everything. Those aren't equivalent risks. This is about insurance, about protection, about making sure that no matter what happens, whether we get inflation or deflation, whether we get a crisis or a slow grind lower, you have something that will hold its value. Because throughout all of human history, across every civilization, every empire, every monetary system, gold has held its value. Paper currencies haven't. The Romans debased their currency. The Spanish inflated theirs with New World gold and silver. The French tried paper money multiple times and failed every time. The British pound used to be the world's reserve currency, backed by gold, until it wasn't. Now it's just another fiat currency, worth a fraction of what it once was. The dollar will follow the same path. Not because Americans are bad people or because the US is doomed, but because that's what always happens to fiat currencies. They start with good intentions, they're backed by the full faith and credit of the government, and then slowly, inexorably, they lose value as the government prints more to fund its spending. It's not a conspiracy. It's not a political statement. It's just history repeating itself, the way it always does. And gold is how you opt out of that cycle. It's how you say, I'm not playing that game anymore. I'm not going to let my wealth be eroded by decisions made by politicians and central bankers who have every incentive to inflate the currency. Because that's what they're doing. Every time they print money, every time they run a deficit, every time they keep interest rates artificially low, they're transferring wealth from savers to debtors, from the prudent to the reckless, from you to them. Gold is how you protect yourself from that transfer. It's how you preserve your purchasing power across time, across crises, across changes in the monetary system. And right now, at this moment in history, with gold at $3,900 and climbing, with central banks buying at record levels, with the BRICS nations building alternatives to the dollar, with debt at all-time highs and money printing continuing, right now is when you need to be paying attention. This isn't a sales pitch. I'm not trying to scare you into doing something stupid. I'm trying to wake you up to what's happening in the world, to the forces that are reshaping the global monetary system, to the risks that most people aren't even aware they're taking. Your family's financial security depends on you understanding this. It depends on you taking action before it's too late. Not panic action, not reckless action, but thoughtful, deliberate action to protect what you've worked so hard to build. Because when the history books are written about this era, they're going to talk about the end of the dollar's dominance, about the rise of alternative systems, about the return of gold as a central element of the monetary system. And they're going to divide people into two groups, those who saw it coming and prepared, and those who didn't. Which group do you want to be in? The warning signs are everywhere. The smart money is moving. The question is, are you going to move with them, or are you going to wait until it's too late? Gold at $3,900 isn't the end of this move. It's the beginning. And your family's financial future may depend on you understanding that before everyone else does.